Welcome, everybody, to this week's episode of the Not Your Average Investor Show. We are right now only on Zoom, going live on Facebook Zoom, hopefully. But as you guys know, I'm your host, Pablo Gonzalez. My co-host, as always, co-founder of JWB, Gregg Cohen. Say hello, Gregg.
Hello, everybody. Thanks for being here.
And today we got a special guest, a good friend of Gregg's. I'm meeting him for the first time face-to-face, but he is the Vice President of NuView IRA, which is a third-party administrator for self-directed IRAs and retirement plans. He's been there for 15 years, right? Has built a whole career there, which I think says a lot. And he's a guest speaker across multiple conferences in the state. He talks to attorneys, CPAs, tax advisors. The guy's an expert in what he does. Welcome, Jason Debono. How are you doing, Jason?
Thank you, Pablo, and I'm doing well. Good to be here with everyone.
All right, man. So we do a little bit of maintenance real quick just to get it out of the way, everybody. We see a lot of familiar faces, but if you're new here, super happy to have you. As you may or may not know, we do these informational shows on Tuesdays at 12:30, and then we do a Q&A on Thursdays at 12:30. And we have this Facebook group that everybody interacts with throughout the week. If you're interested in that, that's kind of our little cool club. That's jwbrealestatecapital.com/group. Go there. I'll put it in the chat. Also, to interact with us, if you have a question that you want answered live on the show, please go to the Q&A box in below and you can put it in. I advise that you put in your full name. So that way, if we don't get to the question, we'll have somebody reach out and answer to you. And if you want to chat with all of us, just like Gregg said, change the drop-down menu to all panelists and attendees inside the chat, and you can get to know each other, right? We're trying to build a community here. So without further ado, if you have a specific question, you go to chatwithjwb.com, get on the phone with our sales team. We can explain directly how to do all of this stuff. Add rental property income to your portfolio as is. And speaking on that, we're going to talk to Jason about how to use your retirement funds in order to accomplish that, Jason. So that's it, man. Now it's on you, right? When I see a guy that's been at a company for 15 years, I think of a couple of things. I think of somebody that is passionate about what they do. I think of somebody that's hardworking. I think of a culture that you fit into. Can you tell us a little bit more about NuView IRA and your career and how it kind of all fits in here, Jason?
Sure. I'll start by a big stroke of luck. Without a doubt, I think anytime you can do all the right things, but if you don't have a company that you work for, represent, that shares those same sets of values, it may not last nearly as long. And I think the second piece of it is the industry. What I love about what we do and why I've become so passionate about it is because, we don't just sell something that we make money on and we think is good, but no one else does. We get to educate and help people on how to use their money and keep more of it. And I think it's just been a fun ride. And over the last 15 years, I've got the ups and downs of the markets. Starting in 2005, we saw a huge jump in real estate, and we've been through slides and everything in between. So been a fun ride. Happy to be, with a great company and be able to grow with the company. And honestly, as cliche as it is, you do what you love and you never work a day in your life. And probably 90% of my time here, it feels like I'm not working.
That's awesome, man. Can you tell me a little bit about what a self-directed IRA and retirement plan is? Like, what does NuView specifically work on?
Sure. So, simply put, our business is just like Charles Schwab, Fidelity, TD Ameritrade. We are custodians of retirement accounts. So we hold the retirement account and we buy and sell your investments inside it and do the reporting to the IRS. So if you kind of step back and look at it, we're exactly like those firms. What's different is really two things. Number one, we don't have any investments to sell. So at Schwab or Fidelity, they all have packaged up products, stocks, bonds, mutual funds that bear their label in some way, shape, or form, and they sell those. The second thing is we don't restrict our clients to stocks and bonds. So clients come to us because they want to buy something that's not traded. Most common investments being real property, real estate of every possible type and classification, private notes, promissory notes, private debt, and then private entity, private equity type investments. So all of the above, but it boils down to clients get to choose what they want to buy. and they get to choose from a much bigger menu of investment choices. But at the end of the day, it's the client's responsibility to figure out what's best for their retirement. And we love putting the power back in the hands of our customers.
That's awesome.
So Jason, all right, you got to take me back a little bit. I want to know, so now that we know that there's a full menu of options out there, largely the people on our call here want to learn specifically about buying rental properties with your retirement accounts. All right, I want to know, what was it like for you when this option became a reality? Like for me, when I was in corporate America, I thought that I could only invest in stocks and bonds, and that was the only way to do it, and there was no other way that I could invest in anything else. And when I came across the opportunity through a company like NuView Trust to be able to invest in rental properties, I was like, wait a second, it kind of shook my investing course. So what was it like for you personally when you realized this, and what have you seen others who have experienced this do with that knowledge?
Well, it's kind of a funny story, if you will, because I was so naive to what investing was in general. I started here as my last semester of college. And so, prior to that, I always kind of thought rental real estate was what my dad did. He owned a couple rental homes, and, I always thought every 6 to 12 months we went and cleaned the urine infested carpet out, and Dad put us to work pulling weeds and getting the property ready for rent. And I always thought, man, all my dad ever does is complain about this stuff. Why does he do it? I didn't understand the monetary side or opportunity. And, fast forward to 2005 when I left kind of the interview and I was interviewing for internships. And so I was fortunate to have interviews with quite a few companies and some household names and jobs and what appeared to be career opportunities that I thought were so cool, Callaway Golf and SeaWorld, and how cool it would be to work for any of these firms. But it was really my dad's kind of response when I talked to him about NuView both before and after the interview that caused me to say, wait a minute, this may be a tiny company that doesn't have brand recognition, that's not Callaway, but man, they're onto something. And when I called my dad and kind of I asked him about buying real estate in an IRA from the get-go and before the interview, and he was, the first thing was like, you can't do that. And obviously as a young college kid, you can imagine, right? Dad says you can't do it, has me 10 times more intrigued. And so in the interview process, for those that know our founder and CEO, Glenn, super guy. And he just candidly asked me, do you know what NuView does? And I remember kind of thinking, oh boy, this is a very tough question because I don't. But I don't want to come across as not knowing. And so I think I kind of jokingly said, I've been on your website. Looks like you help clients buy real estate in an IRA. But my dad said, you can't do this. And so it kind of went from an interview into a lot more of kind of an overview, an educational class on how to do it. And when I picked up the phone and called my dad after the interview, and I was so excited because now I knew something Dad didn't know, right? So I quickly kind of rubbed that in his face. And I remember my dad's comment, and he said, I wish I'd have known about this 10 years ago. Right. And I thought to myself, man, where else is there an opportunity to kind of get in with a small company? I mean, I was employee number 3 at the time and really kind of help, I joined as a sales and marketing intern to try to kind of share this message and story. And I thought, my dad is kind of a typical boomer. He's, been hardworking middle class his whole life. And here's someone that, has always been told he couldn't do this, yet he's always bought and sold real estate, but he's always put his entire retirement plan at the mercy of a broker in the stock market, which for some people makes great sense. But for my dad, who had the both wherewithal and the willingness to go buy real estate, it always outperformed the stock market for him. Yet he never took advantage of doing that in a tax advantaged account. So kind of a little bit of a long answer, but kind of a roundabout way when it really hit me that, man, this idea of buying real estate in an IRA is so cool because so many people simply don't know that they can do it. And I thought, man, what an awesome opportunity. And it turned out to be absolutely the case.
Not too many young 20-somethings look at that next career and say, oh man, tax savings, that's really attractive to me. If you're like me, like I was an oddball with all of my friends at that time, I'm like, oh man, we can we can buy rental properties. They can be tax deferred. Like how this is going to affect me in my 60s. This was my train of thought. Sounds like it was your train of thought too, as what you were doing in your early 20s.
Yeah, and without a doubt, it's probably not the average course of knowledge for a 20-something-year-old wet behind the ears. But man, you know, what you grow to appreciate is you don't have to be an expert in all things. But if you both are lucky enough and put yourself in enough situations, you can surround yourself with a lot of smart people that can share some information that just makes you kind of go, wow. You know, and I think back, if I didn't take this job and I chose a different career path, and let's assume I worked for Callaway for 15 years and I had a nice 401k, I don't think today I would even know how powerful real estate is as an investment. And I certainly wouldn't know that there was alternatives to the stock market from an IRA or retirement plan perspective. So, you know, it's kind of interesting to see sometimes when you get to a path and a fork in the road, you know, and really look back and wonder what would it have been like. And I think I'd be just like the average, you know, kind of run-of-the-mill corporate American citizen out there just working, you know, expecting my 401k to grow and retire. And I think, unfortunately, for a lot of people in the last, you know, month or 2 months, that they've seen their retirement elongated by 5 years overnight. And that's the stuff that always worries me. And I've learned over the last 15 years to be so mindful of is you got to really focus on controlling what you can. And if you put all your investments into stuff someone else has full control over, you're going to find yourself in. And that's tough. Not to say that doing it yourself or buying real estate is foolproof. There's plenty of ways to lose money, but there's also a lot of ways to pivot quickly and make sure that you're making decisions with your money to navigate through situations that are unprecedented, like we're in today.
I think that you framed it perfectly, my friend. So now I want to tell people that we see the questions, Karen, Kieran, Lee. We have a couple of anonymous attendees to which I encourage that you put in your name so we can follow up with you, because sometimes we don't get to all the questions because we try to give as much value as possible. But Jason, you know, you've explained the value of it pretty clearly to me. Can you tell us the mechanics of how if you are that corporate America person that's like, oh my God, I didn't know I could do this. What do you have to do to be able to use your retirement funds in order to invest in rental income properties?
Yeah, and thank you for that question. I'll answer it in kind of general terms, and there may be some nuances to the type of retirement money you've accumulated over the years. So, you know, again, take a little bit of what I'm saying and understand your situation may apply slightly differently, but I'll talk in generalities. You know, it's believe it or not, relatively simple. It's different without a doubt. You know, you are not going to simply log into your online portfolio, click a button and add Microsoft to your account, right? And for a lot of people, they've been trained that that's the way that they invest. So in a self-directed account, the first thing is, like any account, you got to have an account with some money in it to go make investments. So, you know, we'll set up your account, a couple of sets of documents. You can do it all electronically online. But that establishes the account, and then we'll move money from wherever it may be sitting today. So, you know, if you've got an old 401k or IRA money sitting around somewhere, you can liquidate that to cash, and we'll transfer it into an account at NuView. Once it's here, it's fully self-directed and ready to be deployed. And the self-direction means you, as the IRA owner or account owner, need to go out and either find your own investments or find people that can help you find investments. And I know JWB has done, you know, a great job of that over the years with a lot of their customers. But ultimately, it's up to you. Due diligence, understanding what you're buying, how long you plan to hold it for, whether it's good or bad investment. Those are all decisions that our clients get to make. And once they've made those, it's just a matter of walking through the process with one of our team members here. You'll have to provide a couple sets of documents. Obviously, the type of investment will dictate what's required. And once you do that, we'll buy that investment on behalf of your IRA, just like Schwab buys Microsoft on behalf of your account. We'll hold it. You know, we always actively encourage our clients, if it's rental property, to have a property manager so that you're as hands-off as possible. But we'll collect any rent, pay any expenses through your guidance, or we'll work with your property manager that can assist you in that process. And then each year we'll report it to the IRS, and you can continue to be the decision maker for your account, right? Deciding on how much to rent it for, who to rent it. You just can't be the one in there if you decide to paint it with the paintbrush, right? You've got to farm that stuff out so that you keep it as an arm's length investment. All investments have to work that way.
Sounds like, I've only been aware of this concept through my involvement with JWB, right? So I was one of those people that wasn't aware of it. Now we talk about it all the time, right? But this is the deepest I've ever gone into it. Sounds like then you don't only cater to a JWB type of turnkey rental income property. This could be anybody that is looking to purchase real estate and just manage it themselves. It sounds like it could also be somebody that wants to just buy their own stocks or bonds or ETFs or whatever, maybe even gold, maybe other things. I mean, is there a wide range of investments that somebody can now do it when it's self-directed like you described?
Yeah, and you brought up a lot of really good points. I mean, our job is to provide the passive custody that's required, right? So simply put, we're not here to do the investing for you. We're here to take your direction. But you're absolutely right in that, there's a lot of different ways, and it's not. People think that by self-directing, it's a different type of IRA or the process is different, and it's not. Self-directing simply means you're choosing different asset classes. So just like in the stock market, you can choose to go online, do your own research, educate yourself, and go out and buy stocks, right? Or you can choose to find an advisor who does all the legwork and research for you, right? And you can, through them, go buy stocks the same way, but you're relying on a third party's expertise. Kind of going back to JWB, it's no different, right? An investor can go out, do the legwork, find the property, do the education, understand what due diligence looks like, and they can go directly to us and make the investment. Or they can go to someone like JWB, someone that has the expertise to go out and find the properties and do some of the legwork for them. It's a client choice. We can service both sets of customers. And at the end of the day, I think there's a case to be made to do a little bit of both. I think everybody should blaze their own trail and really understand how to build wealth. We use the internet to learn all kinds of foolish things. It wouldn't hurt us to use the internet to learn some really relevant things like investing. But I also think no matter how long, you've been here, I've been here 15 years. I've been in this business. I've made lots of different investments. And every day I'm around and meet people that I go, gosh, he or she is still way smarter than I'll ever be in this business. So while I feel like I've got enough experience to give me the confidence to go make investments, I still rely on third parties frequently to help me navigate investments. And I do buy investments through other people. Again, you're never going to know it all. And so the more you can surround yourself with smart people, the better.
Sounds good. So listen, we have a ton of questions. So I'm just going to go right into some of these questions that are rolling in. A couple of people have asked, how do NuView's fees compare to a traditional IRA or another company like that?
Yeah, and fees as a general rule, the first thing is you have to understand how companies make money. So companies like Schwab and Fidelity, if you've noticed, they've said they're no fee accounts. Well, we're a fraction of the size of Schwab and Fidelity, and we have half, 1/1000th of the budget of Fidelity, because make no mistake, they're making fees. Fidelity and Schwab and most financial firms make their money on the investment side. So when you go out and you invest into, these, funds and mutual funds and other things, everything that bears the Fidelity logo has a rake out of it, right? Could be 1%, 2%, 3%. That's investment fees, not advisory fees. So if you have an advisor on top of that, average advisory fees are around 1 to 1.5%. So if you have a $100,000 account, you may be paying an advisory fee of 1%, which would be $1,000 a year. And you may have a fee in a mutual fund of even 0.5%, which is another $500 a year. At NuView, your fees to us are asset-based. So we don't have any investment fees. If you buy a house and you make $1 million, you keep all $1 million of that. Our average fee, our typical fees for clients ranges between $300 to $500 per year. So significantly less than what they're paying. And that's made up of a transactional fee. So as you're kind of generating the activity side, we get a little fee for the activity our team has to deploy. And then on an annual basis, there's some recurring fees that you pay us to do all the record keeping and reporting. But our average client is paying us probably about 1/3 of 1%. of their average account balance, whereas most people are paying between 1% and 2% on their fund-based investments. So it looks like it may be more expensive because you see it as an actual fee versus it buried in the investment. But it is incredibly less expensive to self-direct than it is to own mutual funds and have advisor-based fees. Not to say there's not value in that, right? I'm a big believer with fees, you get what you pay for. So I'm not saying advisory fees or mutual fund fees are unfair or bad, but they're significantly more expensive.
Okay. And I'll add on to that too. As I'm a client of NuView Trust and love working with their team. I've been a client of pretty much all of the bigger, self-directed IRA companies out there. I think the thing that really separates a company for self-directed investment is customer service. I mean, you see much varying degrees of customer service out there. This is a relatively small world. The self-directed IRA world is relatively small. And so fees, you're going to find them to be roughly about the same. We'll call it a little bit more, a little bit less for the various other ones out there. Focus on the service, focus on the people when you go through this investment choice.
Great. And I'll add John Avila saying that he's a NuView Trust client, and the conversion from my old IRA custodian to NuView has been an easy process, right? So sounds like a glowing endorsement all the way around. Jason, congrats, man.
Thank you for that, John. I appreciate it.
Yeah. So I got a question from Kieran, who is our first question that we're now being able to get to. And Kieran Shilamkar, I hope I'm pronouncing that correctly, wants to know what the difference is between the eligibility of a self-directed IRA versus a solo 401k. Is there a difference there?
Yeah, they're two completely different accounts, although they both work very similarly. They're both retirement accounts, so they're both designed for you to put money away year by year and invest that money in a tax-advantaged manner and take it out at a retirement age. And, if it's pre-tax, pay the tax, and if it's post-tax, you'll pay the tax up front. So from that perspective, there's a lot of similarities. An IRA is an individual account. It's not tied, as a general rule, to business. So I, as an individual outside of my employer, you could contribute to an IRA. I can make my own decisions in that IRA because it's not tied to anything. It's tied to me. The 401k plan is something that if you take as a general idea, a 401k is an employer-based plan. So I work for NuView. NuView has a 401k plan. I can contribute to my 401k plan like an employee, and NuView can offer to match, which we do, my contributions, and then I can go invest that money. The thing that the 401ks are great, payroll deduction and other things, employer match. The problem with many 401k plans is they have very, very limited investment choices. So, your employer is the one that dictates that. So the average 401k has less than 10 investment choices, right? The solo 401k kind of sits in between an IRA and a traditional 401k, like a full-blown employer plan, because you get all the benefits of a 401k, right? Payroll deduction, if you will, employer match, and there's a lot of additional benefits. But what you don't have is you don't have any of the employer restrictions, because in a solo 401k, you are the employer. So to qualify for this plan, you have to be self-employed. So you have to have a reasonable expectation of having self-employed earnings, and you have to have no common law employees. So that means that there's no one on your payroll that is, and a spouse is excluded. So if it's you and your spouse, that's still considered no common law employees. Or if you have other owners of 5% or more, they're excluded. So, if Jason, Pablo, and Gregg each own 33% of a business and we have no other employees, maybe than our respective spouses, we would qualify for this solo 401k. And so that's the qualification. What's awesome about it is, we can contribute a lot more money to it. It avoids some potential taxation issues that some IRAs can hit. And you get a little bit more simplicity of being able to manage the funds more. So if you fall into the camp where you are self-employed, no common law employees, I always recommend and suggest that you go the route of the solo 401k. For those that don't qualify, that's okay. The self-directed IRA is still a great tool, right? You just don't meet the criteria to jump into that solo 401k.
And specifically for real estate investors, there's a lot of solo entrepreneur real estate investors out there. It might not be how you're doing your passive income rentals. It might be your more active business. And I know we have a few folks I think Eric Wachtel is a active real estate investor, I think in Ohio up there. You know, for you solo entrepreneurs, it is definitely something to look into. The solo 401k might be a really positive thing for you.
And NuView, for us, we offer both the solo 401k and the IRA. So we're ambivalent as far as what you choose. It doesn't matter to us. We want you to choose the plan that gives you the ability to sock away the most money, have the most simplicity over investments, that's going to generate the best tax advantage growth for you in your situation.
And to put some numbers to it, Jason, correct me if I'm wrong here, but the contribution limit for a self-directed IRA, I believe, is $6,000 for the year 2020, and for a solo 401k, it's upwards of $50,000.
You got it,
right? Okay.
Yeah, you got it. That's one of the biggest benefits of the solo K. If you're looking to contribute, if you go with a traditional or Roth IRA, you're capped at $6,000 annually. It may be $6,500, and Google can correct that part. But on the solo 401k side, you get to contribute as the employee up to $19,000. And then you get to turn around as the employer, right? Same person, different hat, and you get to contribute up to 25% of your income with a cap of, I think it's 56 or 57 or something $1,000 total. So you can, you're talking about 9 and 10 times more money on an annual basis, which obviously is an attractive contribution limit when you're talking about putting it into a tax advantage vehicle.
Excellent. So real quick, I know we had a little bit of issues with the Facebook Live. We're coming up on that 1 o'clock that the original call was scheduled for. Jason, do you have a little bit more time that we can crank through a couple more questions?
Yeah, happy to.
Okay, great. So before that, anybody that already had the half an hour call just in their time frame, if you have more questions, we're going to reach out to anybody that's put a question up here and answer that specifically. But if you want to hop on a call with somebody from our team to get these questions answered, non-pitch, non-salesy, just value add, go to chatwithjwb.com and set up an appointment. And that's the best way to just get the conversation started, or come into our Facebook group and engage with us in there, which is jwbrealestatecapital.com/group. Got that. All right. So I'm going to just keep diving into these questions because there's a ton of them. This is awesome. Karen Padower asked, and I think this might be a you question, Greg, if a person has cash to buy a rental property or can get a mortgage, and also has cash in a self-directed IRA, which is the best way to buy, considering costs, tax benefits, maintenance costs for the house, trying to figure out how to start passive income most prudently and effectively?
So, okay, I want to make sure I understand the question. Was it having money outside of a retirement account and then having money inside of a retirement account, and which is the better way to start purchasing passive income properties?
That's what it sounds like. She's got cash to buy a rental property or get a mortgage, and she also has cash in a self-directed IRA. What is the best way to get started?
Well, I think it is not mutually exclusive. Like, what I look at is, what are your investing alternatives outside of your retirement account? And then what are your investing alternatives inside of your retirement account? Because there are some things that are different. Investing outside of your retirement accounts has some advantages, specifically on the financing side, that you're just not able to get when you invest inside the retirement account, right? But investing in your retirement account has advantages from a tax savings perspective that you might not always get outside of the retirement account. And so the first place that I would look is, I would look at the total amount of your overall financial portfolio and understand what your asset allocation should be. I should have 50% in the stock market. I should have 33% here. I should have, 10% in bonds, or whatever you decide. Make that decision for yourself and look at everything that you have both inside and outside of your retirement account. Then you can then focus and say, well, if I want 25% of my overall portfolio to be in rental properties, then we can start to look at where that bucket of money is, whether if it's inside the retirement account, we'll go and we'll put the best plan in place to put those funds to use. So it's not a one size fits all as to where you should start first. But I think your asset allocation will decide what bucket of money you should put towards it. And the reality is that, sometimes saving up $50,000, $100,000, $200,000 outside of your retirement accounts takes time, right? A lot of us have money in our retirement accounts that may be sitting there, and you may not be happy with where it's going right now. And so that is a real opportunity to reallocate some of those funds that are in the stock market, that are in bonds, that aren't performing for you, and move those over to rental property investing. So hopefully that gives you a little bit of a head start, but I would really encourage you to jump on the phone with my team at chatwithjwb.com. Get on the phone. We're going to talk through that. That is a really common question. Unfortunately, there's just not a one-size-fits-all answer, but you can't get an answer really quickly. Probably take a half hour, 45 minutes of a phone call, and we can give you, a really good sense of where to start.
Yeah, and I'll just kind of add in if that's okay. And one is, Gregg hit it on the head. It's not mutually exclusive. So many people think it's an either or decision, and it's not. Everything he said was as spot on as you could be. And the decision first is, what is the investment asset class based on your age, risk tolerance, and goals. And if that number is 33% or 10% or 100%, there's no wrong answer, right? Whatever that is, then look at the different buckets of money you have. And I'll take it a step further to say, what we see in a lot of our clients invest in real estate, both with their retirement money and outside the retirement money. And the decision that they're making is not whether or not they should do it. They look at each asset, to Gregg's point, is what's the tax benefits if I do it outside versus what's the tax benefits if I do it inside? And the beauty of having both, first of all, congratulations, you've set yourself up in a great position. Not many people, have the financial discipline to have money in all those different avenues. So kudos to you for being in that, position. But secondly is you can look, the real success in investing is picking investments and letting the type of investment, the strategy, the structure, the amount of time you're going to hold it for, all of those things, use that as your guide to what account it fits best into. And you'll be amazed. The answer may be a lot clearer. And I'll just give you one quick one, which is if you're going to flip a property, right, that's a property that makes great sense in an IRA because you're going to have short-term capital gains tax on that, depending on your tax bracket and rate. And there's not a lot of personal tax benefits to flips, right? So you're foregoing, if you do it with the IRA, you're giving up a little bit of tax benefit personally and get tremendously on the IRA side. Whereas if you have a true long-term buy and hold rental with depreciation and other things, that may fit better in your personal account for the tax benefits. And you may find other strategies to deploy your IRA money. So definitely look at each investment and really understand pros and cons, and then choose, once you've decided on the class, the asset type, and the investment, then look at the buckets of money and figure out where the best opportunity lies.
Excellent. And, a couple of people have asked this, and my apologies that I haven't done this, but Jason, if people want to get in contact with NuView or get in contact with you, why don't you tell the listeners how to do that? Because you're obviously giving out a ton of value here.
Sure. Easiest way to reach our office is 877-259-3256. That's our general office phone line. The company website, NuViewTrust.com. There's a little chat bot there. You can also type your questions into. My personal email, I'll gladly share with you guys if you want to reach me directly, is Debono, like my last name, Debono. At NuViewIRA.com. And NuView IRA and NuView Trust, one is the trust company, one is the servicing company. That's why we use both of those, different brand names, but they both work on client accounts in the same manner. So NuViewIRA.com, and I think Pablo threw it up on the screen for you guys there in the chat, but that'll get you to me directly.
There you go. And we got a couple questions rolling in that seem to be from people that are employed by the government. So I'm going to couple them. Lee Bishop, who, by the way, is going to be a guest in a couple of weeks coming up. Breaking news. My son is in the Coast Guard and has money to invest. I thought you had to have a solo 401k LLC retirement account to invest in rental properties for passive income. I was wondering what we could tell him to invest using a self-directed IRA. Does he have to have someplace specific to direct money before he can call Gregg and JWB? And Roldan Crepo asked, how applicable is all this info in relation to those federal government employees who have TSP, thrift savings plans?
So again, I'll kind of answer it generally, and Lee, I think I understand the context of the question that you asked, but if I miss it, please, throw it back in the chat and we'll try to clarify it. The first thing, let me start by saying, based on just how you've asked the question, there's a lot of information out there that may not be accurate. And what I mean by accurate is, a lot of people suggest the only way in order to self-direct your account, you need this LLC, or in order to self-direct, you have to have this solo 401k or be self-employed. And the reality is all of those are incorrect. You can self-direct an IRA, you can set up a solo 401k, you don't have to add an LLC. And so sometimes that information can be jumbled. And so as a custodian, not to say that we're the smartest and best by any stretch, but we are as neutral as they come. Anyone promoting the LLC sells the LLC. Anyone promoting the solo 401k only sells the 401k. We're agnostic because we don't deal with one specific item. We are a custodian of all investments in all account types. So we are all things to all people. So when we share information, acknowledge it's not pointing you to what we offer or sell. It's simply educating you on what's out there. So I want to start there. The difference between the LLC, a self-directed IRA, and a solo 401k, they are all different. And sometimes they can be combined, and sometimes they're treated much differently. So I wanted to start there. Going to the federal government side, and this is not any different from TSP, which is Thrift Savings Plan. There's 403Bs, 457 plans, which some of the people here may have, and 401ks. We'll put them all together. As a general rule, you can only self-direct any of that money when you're no longer employed by the employer that provided the plan. So if you have a TSP through the federal government and you're actively employed, you probably are going to be ineligible to move that money out. And it just has to do with how those plans are structured. If you were to leave the federal government or transfer your employment to another place or leave the Coast Guard or whatever those cases may be, then that money that you've accrued as a general rule is eligible for rollover. And then we can roll it into either the self-directed IRA, the solo 401k. If you want to go the LLC route, you can do that. But all those decisions come after you become eligible to move the money. So hopefully that answers the question. Please, kind of add some clarity in the Q&A if for some reason it didn't.
Yeah, I'll tag along there just a little bit. So lead to the question about your son. If he has a self-directed IRA already, nothing preventing him from owning rental properties right there. I mean, so for example, I don't have a solo 401k because we've got 80 employees at JWB, but I use my self-directed IRA to go and invest in rental properties, in private lending, in some of those things. So if you're looking for the quickest path, you probably don't have any limitations if he already has a self-directed IRA for your son in that case. And the other thing to point out is what Jason mentioned as far as there being some limitations if you're actively employed in those government roles. Many times that's the same way. If you already have a company 401k plan, you're not going to be able to take that company 401k plan and to self-direct that while you're employed with that company. So what that means is if you leave your company, that is about the best time to jump into self-directed investing within rental properties or private lending or anything of that nature. So what a lot of people do is they leave their company, they go and they get a new job, and they roll that 401k that they had from their old company just simply into the new company plan, and then they lose that flexibility. So this is a time if somebody has recently had a change of employment, take a hard look and see, is this the time to self-direct those funds and maybe take advantage of another asset class?
Excellent. That's interesting. Okay. Jason, if you use retirement from 401k and put in self-directed IRA, do you lose the tax benefits of owning the rental property? That's from Eddie Harris.
Again, in kind of like the last one, Eddie, if based on the context, I'm not 100% sure what you're asking because it appears like they're two different things, but I'll answer it the way I think maybe it was meant. And please, Eddie, if I missed the mark, just notate that and we'll readdress it. But there are two different areas where tax advantages exist. One is in the account side, which is the 401k/IRA, and the other is the investment side, in this case, real estate. When you move money from a 401k to an IRA, you keep all the same tax benefits as you move that money. There's no change in that. And changing your investments inside your IRA from 401k or IRA or 401k from stocks and bonds to real estate doesn't change the tax advantage growth. So your retirement account is either taxed when you withdraw it, which would be pre-tax, or it's taxed in, which would be the Roth. And you're never taxed on an annual basis on any of your investments from a standpoint of tax advantage growth. So you have that working for you regardless of whether you choose stocks or whether you choose real estate. If you choose to buy real estate inside an IRA instead of personally, kind of going back to the question earlier, then what you're doing is trading the personal tax benefits that you may get with real estate ownership, like depreciation. You're putting it into an IRA where you forego depreciation because you can't claim any personal tax benefits on real estate that your IRA owns. But what you're giving up is that depreciation and other items. What you're gaining is the tax advantaged growth on the money inside the IRA. And that's where the real success in both wealth building as a whole is being able to understand both the difference and then choose the investment and then take that investment choice and determine which it belongs into. So 2 different types of tax benefits. You're going to get one or the other as a typical scenario. And generally one is going to be better than the other. Although there are some cases where it's close enough, it really doesn't matter.
Excellent. Can you move only part, like 50% of your IRA to NuView?
Yeah, absolutely. There's no requirement that you self-direct everything. So we have lots of clients that we hold a piece of their retirement plan that they choose to put into hard assets like real estate. And someone like Schwab or Fidelity or a multitude of companies hold the other percentage of their account where they hold stocks, bonds, and mutual funds.
Excellent. Excellent. Okay. We got a ton of questions. How much, you got another like 5 minutes, 10 minutes?
Yeah, I can go about 10 minutes,
okay.
Maybe at 1:30, just,
yeah.
And if we need to find ways to get them all answered beyond that, we'll certainly look at ways to do that for sure.
Okay, we'll take care of it. I just didn't want to. I don't want to have you watching the clock. I'll watch the clock for you, right? So keep swinging at those lobby strikes, and you're. I'm gonna shut up. Jesse Richardson.
That was the best part of the episode right there.
Just gonna. Whoop. All right, Jesse Richardson asks, JWB partners with Fortune Builders and Regency Litho Assets to make available properties to investors. Is NuView Trust an agency that will lend or help to broker a real estate deal? My first property is with JWB via my solo K with HTC, which you're familiar.
Yeah.
So, go ahead, Greg. You want to?
Yeah, I'll take that one, and I'll lob up the brokerage question for you because I already know your answer on that one. So I'll talk about the lending side. So one thing we haven't talked about is, financing. As for those who are on the show routinely, I talk about how financing and using smart debt is such a tool to be able to grow your rental income portfolio and grow your wealth long term. Financing is completely different inside a retirement account than outside of a retirement account. And we can go into this a lot more if we have more time, or you can of course talk to my team about it. But at the end of the day, the options to be able to get financing inside your retirement account are very few and far between. You need what's called a non-recourse loan. And this is not a loan that you'll be able to get if you just walk into Bank of America and ask them to do a loan. So your choices are a lot smaller now. JWB has those relationships in place to be able to get non-recourse financing for you in your retirement account, which is incredible, because with the same pot of money, you might be able to buy twice the number of assets. And what you'll see over the long haul is as those assets get paid off, you build up 2 income streams or maybe more, depending on the financing that you're able to get. So non-recourse financing is available. The terms are a whole lot different than what you're going to see outside. We're talking about really low interest rates in this environment right now in the 3% and 4% for recourse loans, meaning your normal conventional loans. Totally different ballgame. In retirement account, non-recourse lending, your rates are going to be higher and your down payment is going to be higher. Typically it's 50% down, whereas outside of your retirement account, it's going to be 20 or 25%. So a whole lot of reasons behind that. I would certainly encourage you to look into this as a way to maximize the amount of properties you can actually purchase in your retirement accounts. But neither JWB nor NuView is actually the lender. That's a different relationship that we have to facilitate that. And Jason, you want to talk a little bit about the brokerage side and whether or not you guys actually facilitate the transaction?
Sure. The question around kind of a JWB and Fortune Builders or anyone else, we work with groups. We do work with them, but we also work with groups like them that assist and help people in finding properties. No different than a stockbroker assists in helping their clients find stocks and bonds. We as custodian are passive. So while Gregg's a great friend and I've known him many, many years and, seen him grow his business and help a lot of clients, we don't endorse, approve, or offer, any investment directly to our clients. That's not the role that we serve or provide. So if you choose to go through a JWB to help you find a property, that's great. If you're going to do it in an IRA and need a custodian, we can service you. If you have the same scenario where you need a custodian, but you don't want to go through a JWB, you're going to go find the property yourself or use a different, group organization out there. We can service you as custodians. So we're like the Switzerland of custody. We don't have any. We have lots of relationships. We have lots of friends, lots of people we've gotten to know over the years. But the beauty of a self-directed account is it's up to you. Go at it alone or go at it through a professional. Either way, you get to make that choice, and we'll provide the same custody we provide regardless of who or what process you went through to buy the property or find the investment.
Okay, well, if you're Switzerland and Gregg is the Tony Romo of the show, you can be the Roger Federer. How about that? Does that work?
I love it. I love it.
All right. Marilyn Cotterman, one of our regulars. Welcome, Marilyn. Welcome back. Good to see you.
Hey, Marilyn.
Asks, can you partner your IRA with your personal cash to buy an investment?
Oh man, Marilyn, I don't think we know each other, but a woman right after my heart. Thank you for that. Absolutely, yes. In fact, it's a strategy that I've personally used in my life for a variety of reasons from an investment standpoint. I'll answer the question this way. Your IRA can partner with other IRAs. It can partner with non-IRAs. As long as you keep the money crystal clear, segregated, and pro rata in terms of income and expenses, from that investment. The first probably 10 investments I've ever made in my self-directed all partnered with someone else, and you can partner with people because they have the money that's needed to finish the deal. But you can also partner off with people that have knowledge and experience. So, it doesn't just have to be do you have money or not? One of the things that I've done in the past and still continue to do is, I partner off when I do investments that are into flips. And I can partner with someone that can do all the work and find the properties and knows how to manage that, which is well beyond my comprehension. But I can still participate in the deal. So I may bring more of the money to the table, and they may bring more of the deal to the table. But it's a win-win for everybody. The other thing that I would encourage everybody to take a hard look at is partnering with other accounts that they have. And it allows you to take what people may view as smaller accounts that don't have a lot of value and actually give them value. So I'll give you an example of a deal I did. I have a 401k that we get to self-direct here at NuView. I have a HSA account. So for those of you that are on high deductible plans contributing to HSAs, that plan can be self-directed and NuView can custody that. And for those of you with kids and grandkids, there's a plan called an educational savings account, or a CISA, Coverdale Education Savings Account, that you can look at, that you can contribute to, that's tax advantage and can also be self-directed. So the last loan that I did was part my 401k, part my HSA, and part my son's ESA. And they're all owned pro rata, and the return from that note gets split, based on the ownership interest into each of those accounts. So if you've got accounts that you maybe historically thought were too small to self-direct, don't worry, take the small balance, find someone or other accounts you own that have a large balance, even if it is your personal money, and go deploy it and put it to work and split that money pro rata. It's an awesome strategy. And Marilyn, I can't thank you enough for that question, because it's something that's very near and dear to me and something I encourage every one of our clients to really take a hard look at.
That's something I just learned. That's awesome. I was just thinking about my accounts and how to combine it. So I'm glad Marilyn asked that question too. Eric Wachtal asks, does NuView also do 1031 work?
As of today, and I don't want to put the cart too far ahead of the horse, but as of today, no. We can certainly provide you with a list of companies that we know that provide 1031s, but I'll just go so far to say is it may not be very long before you could utilize NuView as a qualified intermediary for a 1031 exchange.
What is, can you give a quick explanation to what a 1031 is?
Yeah, a 1031 exchange is a way, so and let me go back to IRAs, it's a little bit easier to analogize this way. So if you take an IRA and you buy a house and you sell the house for a $50,000 per 100, sold it for 150. The 150 goes back into your IRA and the 150 can be reinvested. So there's no tax liability associated with that buy and sell. And so you get the full 150 to reinvest. With your personal money, if you were to take 100 grand and buy a house and sell it for 150, you would have $50,000 using simple math of profit that the IRS would want its cut of. If you do a 1031 exchange and follow the guidelines, and I won't get into that today because it'll take too long, but if you follow the guidelines, it would allow you to reinvest all 150 as opposed to paying, maybe $20,000 of tax and only having 130 to reinvest. So it's a brilliant strategy. If you don't know what it is, when we're done with this, Google it and do a little bit of education on it. If you're ever going to own real estate personally, it's a very, very effective tax strategy that absolutely should be deployed in most cases when you're not trying to take the money off the table, but simply move from one asset class or one property to another. And it just helps you keep more of what you make. And I think that's probably the piece of this that I want everyone to take away is, regardless of how you choose to invest, you have to be an investor, right? So whether you're the investor yourself or whether you rely on someone like Gregg and his team to help you with those investments, you have to do that no matter what investment vehicle you choose. Once you make that decision, what makes the wealthy wealthier and why the rich get richer is because they know how to couple both buying good quality investments, meaning they either know it themselves or they have enough money to buy all the professionals in the world. But what they do that most people don't do is they figure out how to pay the government less and keep more. And if you don't know the value of tax advantaged investing, just do a quick Google, search on compound interest and compound growth. And the way that the wealth get wealthier is by making good investments and keeping more of what they make. And those strategies through self-directed accounts, 1031 exchanges are available to the public. So you're in the right place to at least capture the knowledge, and the next step is taking action on it, because being a great investor and giving up 20-30% of your money year over year to the IRS is not going to make you wealthy. Being a good investor and deploying those investments in the right accounts is what will make you wealthy.
Great answer. Just a real quick clarification. The pro rata stuff that you talked about, combining accounts, cash accounts, does that also apply for Roth?
Sure. Yeah, you could use part your traditional, part your Roth. You could use your Roth, your wife's traditional, or your husband's account and your son's account. It really doesn't matter how you slice up the pie. Pro rata means that whatever percentage of the investment your money or account bought is the same percentage of the income and expenses that that particular account is responsible for.
Man, I feel like I just drank from a fire hose of knowledge. This was awesome. We've danced around this subject, but the deep dive was awesome. We didn't get to every question, but I want to respect your time. Jason, thank you so much. Super educational for myself. And I'll kind of cue it up to Gregg to sign us off. And I just want to say, if you have any specific questions, go to chatwithjwb.com, sign up for a conversation. I know, Richard Gill, you asked a very specific question. That's I'll have people reach out to you, but if not, you can just sign up for the appointment at your own leisure. Also join us in the group. We're active there every morning. Gregg does his live walk and talk where he interacts with people and we post insider stuff. It's the cool club. No big deal. That's at jwbrealestatecapital.com/group. And, Thursdays, we have our Q&A, right? You can join us. That's going to be fully open Q&A that we go back and forth. It's less structured format, so you get more time to interact and ask your specific question. We answer those en masse. For that, go to jwbqa.com. I'll put that in here as Gregg is signing us off for everybody. And that's it. I'm going to tee it up to Gregg to kind of wrap it up here. Thanks a lot, Jason. It was really great meeting you, man.
Hey, thanks, Pablo.
Yeah, Jason, it's been great to have you here on the show here. I just know that this is a topic that really, really matters to people. You can see we have more attendance than we normally get, and it's not just because of your stunning good looks. It's because of it's a topic that really matters to people, especially in an environment like we've seen over the last 2 months. People are craving a way to diversify out of what has traditionally been known as the only way to invest in stocks and bonds. So I just appreciate you being here, being on the show, sharing your insight, and more than that, being a great friend, and also somebody that I can beat routinely on the golf course. I just appreciate you, buddy.
Oh man, I knew that was coming, and until we play again, you certainly have that card to play, and I would be playing it if the tables were turned. I will just close by simply saying, first of all, thank you to Pablo and Gregg for putting everything together, and I hope it's okay. To give a shameless plug for our event on Thursday, which Gregg has been kind enough to join us on. But we're putting together, or have put together, a virtual summit. It is mostly an all-day event. We have, I believe it's 10 different speakers on a variety of subjects, all either related to alternative asset investing or self-direction in some way, shape, or form. NuView is not a presenter. We're hosting it. But we brought in a lot of people that again, are a lot smarter than we are on the investment side. And so we're excited to have Gregg and have his content alongside some other parties as well. So if you want to visit our website, nuviewtrust.com, and go to the events page, please register for that and join us. It's free, and it'll be full of great content.
Yes, I will be there. I think it's 11 o'clock is my time spot, right? I think it's around there. So I'm excited.
Well, thanks, Gregg. Thanks, Pablo. And thanks, everybody.
This is awesome. Hey, guys, I'm going to leave the call going. I'm just going to turn, you all can sign off, right? I'm just going to turn off the video. I'm going to turn off the mic so that if you have any other questions that you want to pop into the chat or you want to pop into the Q&A, we can address them on Thursday's Q&A call at 12:30. I'm keeping track of everything. I'm literally taking notes as we were signing off, just so that's why my nostrils are flaring, because I'm thinking about that. And that's it. Thank you, everybody, for being here. This was awesome. We love these Tuesday calls. Next week, we have a best-selling author, Rachel Richards, who authored a book called Money Honey that teaches financial independence for millennial women, and just came out with her second book, which is Passive Investment, Aggressive Retirement, where she breaks down all passive investment strategies. So it's going to be a great call. You're going to get emails and texts from us to sign up. I hope we see you there. Rachel's awesome. I've already talked to her, and it's going to be a lot of value. And I just really, really, really want to thank everybody that hangs out with us on Tuesdays. I know I love it. I know Gregg loves it. I'm going to leave this thing going. Gregg, you can have the final word, and adios, everybody.
We're good, man. We're good. Have a great rest of the day, everybody. We'll see you soon.